Hi everyone, this is Victoria Sandoval with Select Premier Properties. Today I am joined by Abel Tejeda. He's our preferred lender. He's been in the business for about 20 years. Full disclosure, he is my husband. But in this video, we're going to talk about the June housing market update, right? So we're going to basically discuss what's going on with the market, new laws that have passed. We're going to talk interest rates, insurance. So everything you need to know about the June market update. All right, so welcome, Abel. I'm glad that you're on here. You have a lot of years of experience and we have a lot of questions. This market has been pretty crazy. Rates have been crazy, interest rates. So I have a ton of questions that people have been asking me, but I figured, hey, you might be the expert to interview here. So let's start off with interest rates, right? That's what everyone wants to know about right now. Where are rates at? Where are they projected to head? And well, let's start there, basically.
Well, when it comes to interest rates, I mean, it's something that is hard to predict because nobody really can tell what's going to happen. And I'll be honest with you, I've been doing loans since '99. I've never seen so much volatility, both ways, up and down. Yes, everybody knows interest rates are high. Yes, they are. They took a little dip in the past week, which is good. They're still in the sixes, obviously.
Are they mid sixes? Are they high sixes?
Well, you know what? It all depends. Obviously, we can't generalize and say the rates are at 6.5 for everybody because right now, more than any other time, it's really credit sensitive, meaning the better the credit, the better the rate you'll get. But to answer your question, where are rates going? You know what? They were supposed to be lower than they are now, but inflation just the way it is, it's stubborn, doesn't want to go away. I mean, we all see it at the supermarket, everything's super expensive. And
feel about that, the cost of living in San Diego.
Yeah, they've been talking about lowering interest rates for a while, but prices are still high, inflation's still high. So until we see inflation coming down, I don't think we'll see rates come down. So right now they're talking about probably September, the Fed coming in and lowering the interest rates. And remember, the interest rates that the Fed lowers doesn't directly affect mortgage interest rates. It affects bonds, which at the end of the day end up affecting mortgage rates. But when will they dip? I don't know. But one thing I can tell you, trying to predict when rates will drop will probably hurt you, because when interest rates do drop, it'll be too late. You're not going to have an interest rate problem. You're going to have an inventory problem. So for those
we kind of already have that. So yeah, that's just going to and that's why a lot of people are asking, oh, is the market going to crash? Well, if rates are high right now and we have an inventory shortage, what's going to happen when rates drop and then you have double the amount of buyers on the market, right? So that's going to
I personally don't believe the market is going to take a huge hit, because there's no inventory. That's the thing. That's the main driver. Right. I can't see how. And talking about California, I mean, we're talking about right now San Diego. If it's Texas, if it's Phoenix, if it's Florida, that's a different story. Right now, we're just talking about our microeconomy here in San Diego or in California, which is very different than the rest of the country, especially in San Diego. The way we are geographically located, we can't build west. We have the Pacific Ocean. We can't build south. We have Mexico. North, LA, super expensive. The only way we can go is a little northeast towards Temecula, but even that area, it's prices are up. There's a lot of demand up there. So anything can happen at the end of the day, but I don't see prices going down. I don't see prices tumbling the way they did back in 07, 08. So if you want to buy a house and that's what you're hoping and praying for, you'll be disappointed.
Right. Well, and that's why a lot of clients of mine are priced out of San Diego, they're moving to Riverside, right? Because it's a little bit more affordable. You get more bang for your buck. Now, let me ask you this. If you want to buy a traditional home in San Diego, let's just say an entry-level 3-bedroom house, I don't know, I'm going to say 800,000. What kind of income for someone who's considering, who's thinking, that they want to buy a house, but they're like, I probably don't qualify because property prices are so high. In many cases, we do have to have multiple buyers. You do see, husband and wife or wife and wife basically buying with family members to be able to qualify. But what's the number? What's the magic minimum income that you need just to buy like an $800,000 property? So, because some people might watch this video and say, hey, wait, between my brother and my sister and my husband, I can buy, we make that. So what would you?
That's a really good question, but there isn't a straight answer because there are other factors. When looking at your debt to income ratio, it's not just how much money you make, but how much money you don't have to pay out to other liabilities. For example, if you have car payments, if you have student loans, if you have tons of credit cards. So let's assume that you don't have anything else. It will just be your mortgage.
Right.
Zero debt. If you want to buy, and this is just obviously, let's say an FHA 660, I would say an income between 110, 120. Let's say 120 between two people, between 120 and 150. But like I said, one thing to really consider here, it's not just your income, it's everything else.
You can make $250,000 a year, but you can have all these liabilities.
And I see that all the time. I do loans for doctors, a dentist with $300,000 in student loan debt, and they pay $4,000. So that hits their income. So it's not really how much you make, it's a combination of different factors.
Okay. So talking about student loans, I have a son going to college. I want to know, how is that student loan going to affect him when he graduates and starts his career? Do you guys factor that into, should he buy before the loans due? Should he buy after the loans? Well, not due, but when he starts making his payments, should he buy before he has to start making payments, basically?
Well, with student loans right now, it's a little tricky too, because a lot of them are still in forbearance. I know they just started again after COVID. So it's not how much you owe. It's not the $100,000 that you owe. It's your minimum payment. So when we factor in debt to income ratios, so we don't look at the balance of the debt, we look at the minimum payment. The same thing goes with credit cards, personal loans, car loans. Meaning, for example, let's say if you have a credit card that you owe $10,000 and your payment is $100, and then you have one where you owe $2,000 and your payment's $400, because it could be possible. So the $400 is affecting your debt to income much more, because we're not looking at the balances, we're looking at the minimum payments. So now going back to your question about student loans, it's not the first thing I would advise anybody that wants to buy that has tons of student loan debt, I would advise them to refinance or restructure their student loan debt based on the money they're making. They're very flexible. These loan companies, they will work with you. So don't try to if you're trying to buy a house, don't try to get cute and say or aggressive with these companies and try to pay the most to finish making your payments on student loans. Try to set that payment the lowest possible. That way, it doesn't hurt your debt to income ratio. So to answer your question, it would help if they pay it off. But if that's not a possibility, try to restructure the loan so that you can get the lowest payment possible. And when is that the best time to do? Obviously, when you're fresh out of college. Remember, you get a year off to start making payments. But if you're not making that much money, fresh out of college, that's when you want to structure and set your payments. Hey, I'm only making, $30,000 a year, and they will work with you. Okay, so you owe $100,000, just pay us $100 a month right now. And so once again, because the $100 is what we look at, not the 100 or whatever the balance on the loan is.
Right. Okay. That's good to know. Going back to interest rates, what if you're a buyer You want to buy now. You know rates are high. What are your options if you basically say, I need to get into a home now because if I wait until next year, I'm going to pay $100,000 more for a home. Mm-hmm. What could they do to drop their payment? What as a lender, what options do you offer? Can you offer?
You have to get creative right now. I mean, like I said, right now, more than anything, it's about securing a property and get creative with your financing, especially right now with the 2-1 buy down. Let's say there's 3-2, 3-1, 2-1.
What is that exactly?
What that is right now, and this has been going on now for probably a couple of years. Mm-hmm. A lot of buyers don't know about it. A lot of realtors don't inform their clients about it. The same thing with mortgage brokers, mm-hmm. because it's more work, mm-hmm. and then your negotiating skills have to come into play as a realtor.
Right.
Why? Because what I'm talking about, the 2-1 or the 3-1, these are special loans that basically, let's use round numbers. Rates are at 6% right now, let's say. With the 2-1, you basically, the seller gives you credit through the transaction, through your buying transaction, to buy down the rate for the first 2 years. So let's say rates are at 6%. The first year you pay 2% less. So the first year you'll make payments on 4%. Then the second year you'll make payments on 5%. And then at the end of the second year, it goes up to what the actual rate is, which is 6%. Now, what is the strategy behind this? Is number one, to secure a property with a lower interest rate. And when rates drop, then you can refinance at that point. Where will be rates at? We don't know. Especially, remember, we have a change in president coming up. They both have different policies. Inflation, like it's the number one driver of interest rates. So, but the main thing here, if you have to buy a house or you want to buy a house and it's in your plans, don't wait. Don't be chasing interest rates. Don't be chasing what CNBC and CNN, Fox News are saying, because they're talking about the real estate market as a country, as a whole, not just here in San Diego. Like I said, we have more. The bases are expanding. The military bases, I know the one in Point Lomas, it's getting in Coronado actually is expanding. So we have a lot of demand. They come here, they buy with their VA loans. Mm-hmm. So anything, and listen, I do loans. We do a lot of blocks. What I'm seeing is a lot of people are struggling to make their payments, and they're using their homes as an ATM, let's call it, which is not bad, especially if you're paying off high interest rate debt. Yeah. But people are saying people are going to get in trouble. Yes, but whatever trouble people get into, that trouble will be absorbed right away by potential buyers that have been on the sidelines. So I don't see prices coming down. So if you're thinking of buying, secure a property now.
Right. So the 2-1 buy down, the 2-1 and 3-1 buy down is an alternative option where you can get into a home at a lower interest rate, but the seller does have to pay for that. You have to get a credit from the seller. Correct. A concession from the seller.
Concession. That's a word. And it's not just a concession for the buy down, especially if you don't have money for closing costs. So now you need money for the buy down. You need credit for the closing costs as well. And then you come with your down payment.
And you need to make sure too, because some banks are pretty strict when it comes to how much credit a buyer can receive. You have to make sure it does not exceed that credit. So talk to your lender if you are thinking of asking for a closing cost credit and also asking for an interest rate buy down credit. Now, for those buyers that are saying, you know what, I'm going to sit on the sidelines and wait for rates to drop. What do you recommend they do to prepare so that when rates do drop, they get a decent rate, right? Because if you obviously don't get your ducks in a row, rates drop. I mean, you can still get a high rate if you don't meet certain qualifications. So what do you recommend buyers do now to get their ducks in a row so that they can get a low rate?
Great question. And people always get this wrong. People love looking at houses, going to open houses, and then when they're ready, they're trying to scramble to put everything together, right? So they can pull the trigger.
Pretty often, yeah. Mm-hmm.
Yes, all the time. What I would advise anybody, if you're looking to buy next month or next year, it doesn't matter. Sit down with a mortgage advisor. That way you know exactly where you stand and what it is that you need to do to buy now or in the future. It doesn't matter. That way you can sit down and say, hey, listen, I like reverse engineering numbers. I always ask my clients, hey, what would be the max you want your mortgage payment to be, or the max that you can afford? And based on that number, we can come up with a purchase price. And once we come up with that purchase price, we can come up with the down payment. And then we can start strategizing from there. And I can tell them, hey, right now your credit is at 640. But if you pay down or you bring down these balances, you'll be at 730. At that point, they'll be able to get more favorable terms. Just in everything, especially if they're going with a conventional loan, because FHA is not that much credit driven. But if you have great credit, you're coming in with a down payment, you want to make sure that your credit is as high as possible, because you'll get better terms and a better interest rate, and thus a lower mortgage payment.
I see. So in your case, when somebody does tell you that, you say, hey, well, let's get our ducks in a row. Your ducks in a row, you run a simulator to see how much liability they have, how much they should be paying down. That way they are ready to go. That
is correct. That is the main thing we do. And I think that any mortgage advisor should be doing to help other clients, because I mean, it's a different playing field. The way you help them, you're basically helping them, setting themselves for success. And the other thing also is having those conversations like, hey, listen, if you're trying to buy a house in the next year, don't buy a car.
Right.
If you're so, right now we're seeing a lot of those buy now, pay later type of deals. People don't realize that a lot of these do report on your credit report. So they go on
like the Affirm companies, or like
exactly. So they go on vacation and they pay $5,000 and their payment's $600. Let's say that is hitting their buying power, because that's hitting their debt to income ratio. So that's why it's important to, if you're planning on buying in the next year, you can't be doing those things. You can't be buying a car. You can only make necessary purchases. It's figuring out what's more important, that vacation, or save to pay that vacation cash. Don't pay it with a credit card, especially if it has a high interest rate, because once again, we're going to go around in a circle. And let me tell you why.
And making sure your balances stay under 30% also, right?
That's a myth. I mean, it's a good rule to follow, obviously, but it's not always true. But like I said, I mean, it's a good rule to follow. And the reason why we say to keep your payments low is because the higher your minimum payments, the less you will qualify for. So let's say I sit down with a client today and I pre-qualify him for a $700,000 purchase. And then he goes and buys a car. And right now, interest rates for cars are through the roof. If you think interest rates for houses are bad, cars are just out of control. So now he added a $800 car payment. So now instead of qualifying for $800, the way I qualified when we originally met, now he only qualifies for, let's say, I don't know, $550,000. So those additional liabilities that you're taking on directly affect how much you qualify for.
Okay. Well, so good rule of thumb, don't apply for additional credit. Don't run your credit if you don't have to. Try to keep your balances low. For someone who doesn't have credit, what do you recommend so they can start establishing credit?
You know what? There are different things they can do. The easiest, and I always recommend this to all my clients when they come here, and just so you know, that happens quite often, because I always advise people that, hey, listen, let's sit down, let's see where you stand. A lot of times they think they have credit and they don't, or they haven't taken anything out in years, so everything's frozen, let's say, in a way. So if they don't have any credit, they've never had it or established any credit, the easiest thing to do is go to their bank. You just have to be careful when you go to your bank and get a secured credit card. You have to be careful here. I'm saying secured, not prepaid. If it's prepaid, it doesn't report to the credit agencies. So when you go to I know Wells Fargo does it, U.S. Bank, Navy Fed, Chase doesn't. I believe Bank of America, they don't report. So when you go to your bank to get a credit card, and remember, this can be a $300 credit card. So you basically go and say, hey, Mr. Bank, here's my $300. Give me a card. If I make payments on time for a year, they give you your $300 back. But that allows you to at least put your foot through the door and start building some credit. From there, you're gonna start getting offers, meaning in the mail.
Should you take those offers? Should you continue to take offers, credit card offers? Because
you know what, build some credit first. Always start with secure credit cards, because you don't want to start running your credit left and right. And then don't get overly excited when you start getting approved for credit cards and then you get a bunch. You know what? Just do 3. I always tell my clients, just 3 is enough. If you're the main person, the main borrower.
You can piggyback also, right? Off of somebody else's credit to increase your credit score.
Yes, you can always be added. You can always be added to somebody else's credit cards. Which we call it inheriting somebody else's credit. Now, credit card companies are catching on to that, and it's not that simple to add people.
Now, I want to transition into insurance. I mean, rates, obviously, we discussed rates, we discussed credit. The direction that the market is headed in, we don't foresee a market crashing anytime soon. The market's very healthy. Property prices are continuously going up. So we haven't seen any type of halt as of now. It's not a halt. Major concern right now with potential home buyers and existing homeowners. Insurance. What are you seeing as a mortgage broker? I'm getting calls from my clients saying, hey, I got a notice from my insurance company. What insurance companies do you recommend? And then I get on the phone, call you, and you send me your list. But what's going on right now? What's going on in California? What can homeowners and potential buyers do to protect themselves or have a plan B, basically?
You know what? This is a crisis that nobody's talking about. Insurance companies, number one, are fleeing California. That's the first problem. So we have less options. They are trying to protect themselves against claims. I'm having clients calling me, telling me that insurance companies go to their houses. The first thing they do, always now they're doing it. Okay. Yes, but number one, what they're doing is they're doing Google Earth.
Wait, are they doing this before their policy to renew their policy? They go out and say, hey, or they're going out to say, hey, I'm canceling your policy.
Both. They're doing both. Okay. I'm getting both. Number one is that they send them pictures from Google Earth, which is a satellite picture from the top. From basically,
they send your clients photos, is what they're doing?
Yes. Hey, listen, you have a bunch of cars parked around your property, so we're canceling your property. Hey, we see a lot of shingles missing from your roof.
Wow.
Yes, they're going before when policies are expired. Actually, I don't know what the order is. They're actually going to clients' houses with drones to see the present condition of the property. Obviously, if you have trees that are close to the roof.
This prior to, sorry to interrupt you, but are you seeing this prior to them issuing a policy? For instance, you have a purchase money loan and you call this company, because a lot of times clients will depend on you to order the insurance, right, for them. So let's say you call an insurance company, you get them a policy. Are they doing that before they go out to the property? Is that going to be an issue?
They're not. They actually issue it because they understand the importance of issuing a policy right away. Right. But they go and do it's not a full inspection, but they go to check out the property and they cancel policies.
After the fact.
After we close.
So there is no timeline or there is no lock-in period. If you get an insurance policy for a client, basically you get a quote for a year. They collect what, 1-2 months of insurance usually?
No, they collect the full year.
They collect the full year. Okay. So they're collecting the full year and then they go out, they close escrow, and a month later they can go out to the property and they don't like what they see. Then they cancel, they reimburse you for the prorated amount.
Correct.
Okay. So that's happening now. And another thing as a buyer, what I've been told is we're going to now have insurance contingencies in place. So if you're a homeowner or a potential buyer and you're saying, well, what if I can't find an insurance company to finance me when I'm in escrow because the house is in a fire or a hazard zone? Then at that point, you can technically back out and still get your deposit back because they're now adding that insurance contingency onto the contract, which I think is a great protection clause for clients.
I think so too, but here's the thing, and I'm seeing this with a lot of clients, refinance clients. It seems that the fire hazard areas are being expanded. So you could have been in an area where everything was fine and dandy, but all of a sudden you get a notice from your insurance company. And this just happened to two of my clients this month. I'm sorry to notify you that we are no longer able to insure you because you're in a fire zone. So what happens at that point? So you have to look for another insurance company. But once that happens, and now all of a sudden you find yourself in a fire area, no company will insure you. So the state of California has to come in and assist you because that's a law that everybody has to be insurable one way or another. And if a company is not able to do it, the state of California will jump in with, it's called the California Fair Plan. It's basically telling the insurances, hey, you insure them for regular stuff. We'll insure them in case of a fire. The problem, it's in theory, it's a great idea because everybody's able to have a policy. The problem is this: that California Fair Plan, the cost is through the roof. One of my clients went from paying $120 a month to now having to pay close to $600. The other ones, remember I told you this past month, the other one went from paying $80, and the California Fair Plan by itself, it's just $700. So you can see how, especially if you're buying, to add what you're saying about the contingencies, because us as brokers, as mortgage advisors, we just account for $100 a month for homeowners.
Typical cost, right?
Yes, but we're not accounting for the California Fair Plan and an additional $400. Neither is the buyer. So just imagine us quoting a client, hey, your mortgage payment will be $4,000 a month. Like that's high, but I can manage it. And then all of a sudden coming back and saying, hey, guess what? Your mortgage payment is $4,500 because of the insurance, not because you got a bigger house or a nicer house, nicer area, but because of your insurance policy.
I mean, I think these mortgage companies need to invest in insurance companies somehow, because if you're qualifying someone to buy a property, you're lending them $500,000, $1 million, you need to protect your investment. And now if that new mortgage payment increases their debt to income ratio and they don't qualify, they wouldn't qualify originally if they had that payment. Then, I mean, mortgage companies are going to protect themselves. So I think they should somehow, I mean, this is just my opinion, they need to also help with the solution or invest in insurance somehow. But
in a perfect world, yes. And you know unfortunately
they're the ones that are going to lose at the end.
Well, at the end of the day, the one that ends up losing is the client, because they have to sell their homes. And that's starting to happen already. I'm starting to get clients that call me for help. We always jump in, obviously, because they feel lost. So we try to help them. And when we tell them, hey, listen, we're able to get you 3 policies with three different quotes, but your payment will be $600 more than what you're paying now. Especially if you're retired and in fixed income, you can't pay an additional $500 for your mortgage. Especially when you just refinanced to lower your mortgage payment and get rid of debt. All of a sudden, you're back to square one because of your insurance policy. So that's what's happening. A lot of people that are selling right now, it's because of that.
The insurance. And it's just hard to predict. And there's just no way to predict if they're going to start deeming certain areas as fire hazard, or insurance companies just decide, hey, that area is now in a fire hazard zone or an earthquake.
Or if based on their drone examination of your house, they feel that you have to redo your roof. Most people don't have $20,000 just laying there to fix their roof or redo their roof, especially if your house is a little older. People just don't have the money and can't afford that. So yes, it's getting bad. I have a couple of really good friends that are insurance brokers. They tell me that now we're getting out of that problem, that everybody's going to be able to get an insurance.
Oh, that's great.
But at what cost?
Right.
That's the thing.
We know the state will come in and insure them, but we know that can be very costly. But the fact that, that problem's going away, hopefully it's, there's going to be more insurance companies covering, but if it's still as expensive, there's no solution. It hasn't.
Where that's happening a lot in East Chula Vista.
Right.
The bad thing is, not only do they have their mortgage payment, they have their mellow roofs, they have HOA. Now the fire or the California Fair Plan to their payment. I mean, it's brutal.
So for someone that's going through this issue where they get a letter, can they call you? Do you have a list of insurance companies you can recommend, or what do you recommend they do? Just go online and Google insurance companies that will cover me in a fire?
Well, what I want them to do is talk to different companies. Don't just get one, because from my experience, and now there's Bamboo, because remember, State Farm, all these big companies are no longer insuring in California. They're actually.
I love that nugget though. I love that nugget that you just gave us though. Make sure that your house is looking tidy, because if the insurance company decides to go out with their drone and your roof is missing shingles and you have what looks like could be a fire hazard outside, they're going to cancel your policy. So that's really good information.
Yeah. So if I see this too, if you have a tree that's touching your house, the roof of your house, that's a huge fire hazard, and people don't think it is. But I mean, if that tree catches fire, it's going to go straight to your house.
And also, rodents can get into the attic. They use the tree to jump on, and
if you have shingles.
Yeah. So good information there. Okay. So we talked about insurance now. That was a big one. I want to talk about the NAR settlement, which I know you probably have. You're a mortgage, broker, so it's not affecting you in any way. You just basically know what changes there are in the RPA, and that's all you really need to worry about. But us as realtors, now with this new NAR settlement effective August 17th, there will no longer be compensation on the MLS, compensation to the buyer's agent. A lot of clients are coming to me and they're saying, "Hey, Victoria, so I heard that I don't have to pay a buyer's agent anymore." Right now in this current market, when a seller decides to sell their home, they sit down with the listing agent, they sign a contract, and that contract says, okay, the listing agent gets X amount, the buyer's agent gets X amount. Technically, the seller pays that, right? Nothing much is really changing. It's just that it's kind of restructured, if anything. The reason why there was this huge lawsuit was because it was not disclosed. There was no transparency as to how the money was being funneled, who was paying, well, what the seller was paying, who the seller was paying, basically. So now, effective August 17th, our contracts are going to basically specify whether the seller is willing to give the buyer compensation. And if they are, it goes straight to the buyer and the buyer pays their agent. In a perfect world, we would have contracts on both ends, which is now it's going to happen, right? So when you list a property, you have your listing agreement, but now in today's world, a buyer working with an agent is not required to sign a contract, but it will now be required. This is going to be one of the major changes. So if you are a potential home buyer, you are now going to have a written agreement before touring a property. They basically are required for in-person tours and virtual tours, believe it or not. Now so I can see how people could say, well, I don't even know if I'm going to like this agent, right? I don't even know. I mean, I just met her or I just met him. Well, you can always have a written agreement for the purpose of just touring one home, or you can date for 3 days or a week. You can have that on the contract before you decide to marry them for 3 months or 6 months, right? So that's one of the major changes. So if you start in August, if you're starting to look at properties or client agents and you're saying, hey, Mr. Agent, I want to go see this home, just know that that's now going to be a requirement. So on this agreement, the agent specifies how much they charge, right? Okay. So an average agent will charge 2.5%, sometimes 3%, sometimes 2%. So on that contract that the buyer signs, the agent will say, this is my fee. So the buyer will then say, okay, now the buyer is responsible to pay that fee. So if the seller of a property decides that they are not going to pay a buyer compensation, then if the buyer decides to look at that property and wants to buy it and their agent charges 2%, the buyer if they want to buy that property, they're going to have to pay their agent. So it's advisable. I mean, it's like I said, nothing really has changed as a seller. You could have always paid whatever you'd like, right? It's up to you whether you want to pay 0 or 2%. But it's recommended that you do offer a buyer concession now instead of buyer agent concession, because that's going away. It's recommended you do offer the buyer concessions, because most buyers that are going to have a contract, 97% of buyers out there are going to have a written contract with it. Going to be working with an agent, and that agent's going to have a signed contract that says this is what I get paid. So if you're not offering compensation, most likely the buyer's going to say, I don't want to pay that fee, so I'm not going to look at that home.
Okay.
Now, if they don't offer compensation, the buyer still has the option to say, you know what, let me submit an offer, maybe bump it up a little bit, and then ask the seller for concessions. In some cases, the seller might say, look, I don't want to pay any buyer concessions, but wait a minute, if you come in a little higher, I'll be a little generous and I'll give you a concession. So that's what's happening now. There's going to be a lot of changes. Just know moving forward, you're going to have to sign a written contract before touring any property moving forward, even at an open house. You walk into an open house, the agent's going to say, okay, before you enter this property, are you represented by an agent? And they're going to say yes or no. If they are, they have to fill out their agent's information on the form. If they're not, then the agent hosting that open house is going to become their agent in the event that they buy that property, just for the purpose of touring that home, right? So
it seems like it's the client, the consumer, the one being affected the most by this. Are they allowed to use broker credit, mortgage lender credit towards?
Well, if they get a credit, I mean, that's a very good question. If the buyer can do whatever they want with whatever credits they get. So if the buyer has a written contract, because that's kind of like, that contract is pretty much like an invoice to escrow, right?
Mm-hmm.
It says I have to pay. The agent's going to submit that invoice and say the buyer's responsible to pay 2%. Now, if the buyer gets a credit from the seller of 3%, then basically, they can use that 3% to pay for their responsibility to pay their agent, and the other 1% towards their closing costs. And then if their lender is giving a credit, then that other additional credit can be applied towards their closing costs. So yeah, it could. Now, I know there was a big thing with VA, military buyers. The VA normally would not allow buyers to pay agent commissions. Now they have, the realtors have gone out there, they've really protested and worked really hard for veterans and active military. And so now as of now, they are allowing VA buyers to pay their agents. So the VA buyer can go in, submit an offer, ask for a credit. They can use that credit to pay their agent, and they can also use that credit to pay their closing costs as well. So I was thinking our VA, our military is going to be affected the most by this, but thank God there's a solution now. I'm sorry, what were you saying?
I mean, because I'm thinking while you're explaining this to me, so I haven't paid much attention to it. I've just been focused on, believe it or not, there's tons of loans being done right now, and that's what people don't realize. There's a lot of activity. But if you're an agent, why would you ever show a property that doesn't pay any commission?
Well,
or concession, or you know what I mean? For example, if you decide that you're not paying anything, who's going to go see your house?
Well, that's the thing. A buyer. So once let's just say I'm working with a buyer, and the buyer says, I want to look at these 10 properties. I'm now going to be required there's an additional form where you basically list all the properties that we're going to look at. I list all 10 properties, and I'll say, this property offers 2% concession. This one offers 0. This one offers 3. This one, and our agreement is 2, right? So the buyer already knows in the back of their mind that my fee is 2%. And they're going to go down this list, and they're going to say, well, then if this one's offering 0, then let's skip this one. We'll go to this one. We'll go to this one. So exactly, as a seller, and you know what? My sellers, I just went on 2 listing appointments yesterday, and I'm explaining this to my sellers, and my sellers understand. They're sharp people. They know that they need traffic to go into to sell their home. They need people walking in those doors. They're like, why would I ever offer 0? I want to sell my home. If that's the case, then do it for sell by owner, and good luck, right? But having an agent is really, really important.
I mean, it just makes sense. Let's say you're paying 2%. You're selling your house for $700,000. That's $14,000. Mm-hmm. At the end of the day, you'll probably end up, if you're not offering any concession or commission, you'll end up selling your house for less. So it'll cost you more to not offer, right? Because you'll have less traffic, less offers, less everything.
You have 90+% of buyers that are going to have a written contract with an agent. So why would you shoot yourself in the foot like that? You're just self-sabotaging, right? But yeah, that's basically where we're at. So now on the compensation agreement, whatever the agent says, like let's just say the agent, not whatever the agent says, I'm sorry, but whatever the buyer broker agreement says, if let's just say the agent says I charge 2% and then the buyer gets a 3% credit, the agent cannot revise that and say, okay, you got more credit, so let's change that. But let's just say the agent says my fee is 2.5%, and the seller offers a 2% concession. The agent can then reduce their fee if they needed to.
No.
It works, so that can be done. All right. Well, I think we covered a lot. Thank you so much for your time. This was very, very informative. And again, if you're looking to move to San Diego, whether it be in 9 days or 9 months, feel free to reach out. My contact information is going to be on the description below. My number is 619-392-2455. Abel, what's your email address and your phone number? So if somebody wants to call you for a loan or for advice, they can contact you.
That's the main thing. People think that they're wasting my time if they're not ready to buy. It's like I said earlier, it's about better positioning yourself for something in the future. Most of the people I talk to probably don't end up buying a house for 12 to 18 months. That's how long it takes. So it's all about taking the first step. My email, abel@emortgageguys.com, and phone number 619-948-2996.
Thank you so much. Until next time, guys, thanks for watching.
Bye-bye.
Bye.